Hi guys. Today we will analyze Takeda stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. In the past year, Takeda was only an average performing stock in the market. The short-term trend is positive, while the long-term trend is neutral. Support levels are around $14.30 and $13.50. Strong support level is around $13. Resistance level is around $15.40. Strong resistance levels are around $16.50, $17.50 and $19. In the last month the stock has been trading between $14.30 and $15.30 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 18% per year, for last 5 years. We see that the average profit margin of the stock has been around 7% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 251% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Takeda Company: bad, average, and good. First scenario. Takeda will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 0%. Future profit margin would be low, 2%. Future free cash flow to net income rate would be low, 160%. In this case, the fair value of the stock today would be $10. Second scenario. Takeda will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 1%. Future profit margin would be average, 4%. Future free cash flow to net income rate would be average, 180%. In this case, the fair value of the stock today would be $19. Third scenario. Takeda will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 2%. Future profit margin would be high, 6%. Future free cash flow to net income rate would be high, 200%. In this case, the fair value of the stock today would be $31. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 1.2. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Takeda, analysts forecast growth rate around 0% per year in next 5 years, and future P/E around 6. Again, I will use 3 different scenarios for Takeda Company: bad, average, and good. First scenario. Takeda will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 0%. Future P/E would be low, 8. In this case, the fair value of the stock today would be $3. Second scenario. Takeda will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 1%. Future P/E would be average, 10. In this case, the fair value of the stock today would be $5. Third scenario. Takeda will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 12. In this case, the fair value of the stock today would be $6. As you can see, today the stock is overvalued, $15, even if we expect the company's high performance in future. Takeda is expected to show a decrease in revenue. In the coming 5 years, the revenue will decrease by -0.5% yearly. It's bad. Also, the stock is currently overvalued. With a yearly dividend yield of 5.27%, Takeda could be a good candidate for dividend investing. However, the company pays out 64% of its income as dividend. This is not a sustainable payout ratio. I will not touch this stock in the next 3 to 5 years. Company strengths. Takeda Pharmaceutical is a Japanese multinational pharmaceutical company, with partial American and British roots. It is the largest pharmaceutical company in Asia and one of the top 20 largest pharmaceutical companies in the world by revenue. The company is focused on metabolic disorders, gastroenterology, neurology, inflammation and oncology. Profitable position as the largest drug maker in Japan and global presence in nearly 25 countries. Takeda effect in which sales and marketing work closely to revitalize product showing flat sales. Strong product pipeline and over 36,000 employees. Good positioning in endocrinology market. Takeda's return on assets of 3.5% and profit margin of 8% are amongst the best returns of the industry. Risks. The company is largely dependent on its 4 blockbuster therapeutics. Product recalls and discontinued projects have earlier affected image. Limited presence in emerging markets. Japanese healthcare reforms encouraging generic prescribing. Increased penetration of Western players in Japanese market. Natural calamities in Japan. Takeda is expected to show a decrease in revenue. In the coming 5 years, the revenue will decrease by -0.5% yearly. Based on estimates for the next 5 years, Takeda will show a small growth in earnings per share. The EPS will grow by 3% on average per year. Takeda's return on equity of 8% is worse than the rest of the industry. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.